Welcome to ATS, India's only broking house which provides zero brokerage for both intraday as well as delivery. Here is a new video on the winning strategy for your portfolio. So guys, as the name of the fund is winning fund, it is clear that if you follow this, it is almost certain that your portfolio is going to be a winning portfolio. The portfolio is built on India growth story. It is very clear that the next decade belongs to India, with the per capita income of Indians enhancing multi-fold, and also with the humongous capex in the pipeline. It is evident that higher the capex, the more probability of growth will be. And also the present government is bringing reforms as and when required to make India a global giant. And also our portfolio's ideal duration is of 5 years and is betting on India's growth story, as it is anticipated that the GDP of India will be around $8 trillion by 2013 from presently $3.15 trillion, and also the market capitalization of India will be, in base case scenario in 2030, will be around $10 trillion from presently around $3.5 trillion. And apart from this, many other factors such as our surging IT services exports and also the demographics which we have, that is the youngest population in the world, make us believe in India growth story. So our portfolio is targeting large or mid cap stocks of tomorrow, and we are targeting high quality companies in their respective niche which has tremendous growth opportunities ahead. Now coming to our process, that is based on certain algos, we have developed a model portfolio. The parameters that we have considered while building the portfolio is, firstly, we have selected only the companies whose market capitalization is above 8,200 crores. Now this will ensure that we have mostly mid to large cap stocks and some nifty 50 stocks. That will ensure stability in our portfolio and also will remove major chunk of companies that are not good, either due to their transparency or corporate management or performance. Now second parameter that we have considered is that the sales growth of the company in the past 10 years should be higher than 10% consecutively, and the return on capital employed should also be greater than 22% in the past 10 years, and in addition the earnings of the company should have also grown by 10% consecutively in the past 5 years. Now these three criteria ensure that there is good growth both in revenue, then in your profitability. Also, there is efficient utilization of your capital. It ensures that both your top down and bottom up of your P&L is healthy. And return on capital employed of 22% in the past 10 years is also massive. So after applying these parameters, the companies which we are going to get are going to be those companies which have grown fabulously. But there may be certain challenges, because there may be certain companies which would have shown such kind of growth either due to accounting manipulations, or they might have taken huge debts to grow at such a brisk pace. Now to tackle this, we have added some more stringent parameters related to debt to ensure that the companies either do not have debt, or even if they have, it is very little, and some more parameters related to cash flow. Now the parameters related to debt are, firstly, your debt to equity ratio should be within 20%. Meaning, if you have 1 lakh rupees of your own funds, maximum borrowings you can have is only 20,000 rupees. Secondly, your interest coverage ratio should be not less than 3 means EBIT divided by interest should be equal to or greater than 3, means you have the capacity of paying 3 times of your interest before earnings before interest and taxes. Now coming to parameters related to cash flow, we have 3 parameters. Firstly, the company's operating cash flow in the past 5 years should be greater than 0. Now this means that company from its normal business is able to generate cash surplus and it need not resort to financial borrowings to carry out its operational activities. Secondly, the free cash flow of the company in the past 3 consecutive years should be greater than 0. Now this means that the company is in cash surplus after meeting its operating expenses and capex. There are many good companies which do not have free cash flow positive for last 3 consecutive years. Now this parameter will ensure that the company will have good liquidity and cash surplus even after meeting capital expansion. And the third parameter related to cash flow is that the current ratio of the company should be greater than 1.25. Current ratio ideally of 1 is considered very healthy. So the current ratio, that is current asset by current liability, we are taking more on a conservative side to be 1.25, which will ensure that the company's working capital is very strong. And another parameter which we are going to add in the end is that the return delivered in the past 5 years by the stocks on an average should be greater than 20%. This is because if in the past the company has delivered returns along with these parameters, makes the company healthy financially, operationally, economically and efficiently. The best thing is that it also delivers return to its stakeholders, and if it has delivered returns to its stakeholders in the past, it is more likely that in future also it is going to deliver the returns. So after applying so many parameters, we finally get a list of 25 companies. Now after getting the list of these 25 companies, the work is not done, because our research analyst will be continuously monitoring the stocks as they will be doing industry analysis, top down and bottom up research, then management meets, channel checks, and will be including or excluding the stocks accordingly. These parameters have been added because there are over 5,000 companies listed in the stock exchange, and we want to focus more on the companies which have the potential to deliver maximum returns to our clients. Talking about the characteristics of our portfolio is that all our stocks have stellar track record, as they have proved that they have the characteristic of becoming a large cap multi-bagger, and all our stocks are almost with no debt or very little debt, and the median market cap of our portfolio is around 47,000 crore if we leave the top 3 companies of our portfolio, which means the majority of our stocks will fall in Nifty next. Now this Nifty next means the 50 stocks which are after the Nifty 50 stocks, and they have proved that they can be biggie, as they have been in the business from the past 15 to 20 years and have withstood 2 or 3 difficult business cycles, and hence would have built the resiliency. So the majority of our stocks have the characteristics of generating return above the index. Also, to prove it, we have done back testing of last 5 years, wherein we saw that our portfolio has delivered alpha of almost 30% on an average in all the 5 years than the index. It was only in one financial year 19 that is our alpha was only 11%. Otherwise, almost all the years our portfolio has delivered an alpha return of 30 to 40% than the index. Now talking about our composition of our portfolio, the majority of our portfolio lies in IT sector, chemicals sector and pharmaceutical stocks, and remaining 36% of our portfolio is in remaining sectors. And talking about the market capitalization of our portfolio, only 16% of our stocks form part of Nifty 50, and remaining all are either in Nifty Next or are part of mid cap or large cap stocks. So we have a portfolio of future probable gems and a team of expert research analysts who will continuously monitor the stocks to ensure that we generate alpha. So I hope you liked our video, and to know more you can reach out to us at the following details. Thank you.